So are dividend stocks the cure to high inflation and high volatility? You're going to want to see this historical study because dividend stocks tend to outperform when times get rough. So let's check in on our latest insights piece that Alec Young had put together. It's really awesome. Talking about dividend paying stocks offset high volatility. And listen, if you've noticed in your portfolio or just looking at other stocks, some of the best performing names in this bear market have been dividend paying stocks. Now, you might be wondering why that is. Well, let's go ahead and look back at some history. Check out a cool chart. So here we are, we're looking at the S&P 500 return since 1930 to 2022, right? Now, the first thing we want to realize is that 41% of the performance of the S&P 500 comes from dividends, okay? And here's the cool thing is Alec listed all of the performance of the market basically through the decades, whether it's 1930s all the way to 2020s. Now, check it out. Whenever you have a down decade, right, like the 1930s, right, the average performance for the market was negative 5.3%. But if you include the dividends, right, it actually turns out to be a little bit better than flat, right? Because dividends accounted for 5.6%, okay? You look at the 2000s, right? It was a rough period, right? We had a lot going on. We had the tech crash. We had the GFC happen. A lot of things happened. The S&P was down 2.8% on average. If you include dividends, though, you know, it would boost those returns by 1.8%. So basically, the bottom line is when we're in these negative periods of market performance, dividends really start to offset a lot of that performance. And you can notice 40s, 50s, 80s, 90s, the 2010s, right, where they have big performance for the market. Dividends are less of a contributor to the overall performance. And then last, I'll say 2020s, right? We had the market is at a gain of 1.9%. Look how much dividends really added to that contribution, 5.7%. It's huge when the market is under pressure. All right, so now we know that whenever the market is under pressure, dividends can really enhance your performance. But what happens about the VIX? What if the VIX goes really high or goes low or doesn't move? How do dividend paying stocks perform versus non-dividend paying? Well, check out this study. So this goes back to 1990 through April of 2022. And basically what it is showing is the worse that volatility gets, the more dividends outperform. So whenever we look at the performance here below, it's looking at the outperformance of dividend growers versus non-dividend payers. All right. So the first area here is talking about the average in all months when the VIX increased, right? So if the VIX is increasing for a month, how much do dividend paying stocks outperform non-dividend paying? We can see it's just about 1%, okay? Now, whenever the VIX is up and it's less than 10%, it's a little bit of outperformance, maybe 0.21%, all right? Now, whenever the VIX is up meaningfully, say 10 to 20% in a given month, right? This is 1.09%. That is a lot of outperformance. But get this, whenever the VIX is up over 20%, all right, that's when these scary times, you can see dividend paying stocks outperform non-dividend paying stocks by over 2%. So we know that whenever the markets are down for a decade, dividends really help, basically buffer that performance. We also know that when the VIX is rallying, the dividend paying stocks tend to outperform. Well, what happens whenever inflation is running super hot? Well, let's check out this study. All right, everybody knows that inflation has been high, but believe it or not, you don't know this, dividend paying stocks tend to act very well in high inflation scenarios. So this is a chart going back to 1970. This is through 2022, but it's basically looking at the excess return of dividend paying stocks relative to the S&P 500, depending on where the inflation is, okay? Now, here's what's really interesting is the green, that's the highest quintile of dividend yield, right? So Alec was talking about, these blue chip stocks that pay a 3.5%, 4% yield. That's what he's talking about. They really start to shine, and you can look as inflation goes up, right? Where CPI is between 6 and 7%, or it's above 7%. they really outperform. So when CPI is between 6 to 7%, you're almost at 10% performance. When it's above 7%, it's at 7.2 performance. So again, high inflation dividend stocks can be a cure. Now let's just drive it all home, showing the difference in dividend stocks versus those that don't pay a dividend. Check out this chart. Basically, dividend stocks, they offer more upside with less risk. So here we are, we're looking at S&P 500 stocks. This is their annual returns. This is from 1973 through 2022. All right, dividend payers, they're over 9%. That is the average gain per year versus the equally weighted S&P 500, which is lower, and then non-dividend payers, right? So some of these are stocks, it might be growth stocks, they don't pay a dividend, but their returns are going to be less than 5% on average. So listen, dividend payers definitely can help you out over the long run. No question, dividend stocks can offer ballast whenever the market is dealing with all types of issues, whether it's inflation, whether it's volatility. They really are there to help buffer those downside returns. Now, listen, I'm going to show you the ETF that Alec actually likes in this setup. But before we do, I want to ask you to like and subscribe to our YouTube channel because it really helps us out. So of the ETFs that he likes, right, the dividend paying ETFs, he looked at VYM, SDY, and SPHD. The overall winner is going to be VYM because it's got an overall MAP score of 55.3%. It's got a dividend yield of 3.9%. And it's got a very low attractive expense ratio of just 0.06%. The big reason that he likes VYM is because it's got a big allocation to some of the strongest areas of the market that we saw in our data last year. So you're talking about energy, you're talking about industrials, staples, utilities, materials, healthcare, and even financials have a decent weighting in VYM. So let's look at VYM. Let's crack it open and see what the constituents look like. So you've got Johnny John. It's got a 3.16% weight of the ETF. ExxonMobil, just over 3%. JP Morgan, 2.72%. And then obviously Chevron at 2.43%. So these are some big dividend growth stocks inside this ETF. Last but not least, let's look at a chart of VYM and a couple of those constituents. So again, the ticker VYM. And this is looking to track the performance of the FTSE High Dividend Yield Index. We can see that there have been some recent buy signals, right? That's what these green bars are showing in the stock. But if we go back to 1 year, it's basically been flat. I mean, there was some selling that happened a couple of times this year, but flat in this type of environment, I think that is a win. Let's go ahead and look at two of those stocks really quick that were in this ETF. The first one is Johnson & Johnson, ticker JNJ. The price is right around $175. We can see right here, a lot of big money was going into the name. They had some selling that happened in September, but as we start off the new year, we're starting to see inflows into that big healthcare name. Scores really well. And then last but not least, you guys know energy has been super hot. There's nothing bigger and badder in the energy space than ExxonMobil. Got a nice dividend yield. Price is right around $108. And look at this, nothing but inflows over the past year. In fact, it didn't have any sell signals, and that's very impressive. And this is one of the reasons that Alec likes VYM. It's got very steady Eddie stocks in this ETF. What a tremendous study. I'm just so excited to share that data. We've been getting a lot of feedback on this post. If you guys like it, make sure to check it out in the description of this video. You'll be able to click it, read all of that dividend insights. It's really awesome. It's fantastic. Make sure to like and subscribe to our YouTube channel if you haven't. We really have some unique content here. Always remember, none of this is personalized advice of any kind. You got to do your own due diligence. Hey, I'll see you next time.